SVO. A special thank you to our members, our future members and partners for your support and engagement. This morning's webinar is a very important one since tax season is upon us, and you'd be interested to know that there's over 70 folks that are registered with us this morning. So it goes without saying that particularly our small businesses. And in that regard, your business's finances, 2020 introduced some significant changes in the taxation landscape. So we're happy to have one of the best in the business to break it down for us today. I also want to first recognize our staff, particularly Madison Nguyen and Eddie Trong, for pushing the equity issues, particularly for small businesses, and the vaccine distribution, particularly for vulnerable communities. It's great seeing more mass vaccination sites like Levi Stadium and Oakland Coliseum opening. Vaccines will be key to a safe opening for our economy. And our county is making notable progress with vaccinations as well, with more than half of the 65 and older residents receiving one dose of vaccine or more. That means over 200,000 residents have been partially or fully vaccinated. This is great news for our community, and things are moving in the positive direction. So if you have the opportunity to be vaccinated, please take it. The county has also just announced that it will be expanding access to vaccines for workers in agriculture, food, education, childcare, and emergency services. So all good news, heading in the right direction. So a few housekeeping items. Before we get started, I'd like to take care of a few things with you regarding this webinar. It will be recorded and will be posted on our website by the end of today. And to ensure productive dialogue, all participants are muted, and the last portion of the webinar will be reserved for Q&A. So write those questions in the chat box. I want to particularly thank Monique Yamamoto for her work in this outstanding program. I also would like to introduce a couple of board members who are in our audience. Nicholas Adams, who happens to be our chair of our marketing and communications from PP&Co Communications, Joan Escobar from GP Graphics, Ed Davis from PP&Co, one of our board members as well. So now it's my pleasure to introduce Tom Wagstaff from PP&Co, who's actually presented this session at least 4 times, as we discovered this morning. Tom, as he would like to say, has over 30 years experience with PP&Co, and you'd be interested to know also that PP&Co is celebrating its 70th year in business. Tom, would you like to take it away?
Thanks very much. Thank you. Hopefully you can hear us, and we'll proceed ahead. Go ahead and initiate my. Appreciate the opportunity to talk to you folks. This is we did this late March in kind of an emergency format for the PPP loans. And I remember saying at the time, I was hoping this would be the last time we talked about it. And as we just said, this is our 4th presentation. This is a more all-encompassing presentation, but I'm just hoping everyone out there is making progress in these difficult times, and that we're all able to start working together and seeing each other again. I'm a little tired of I need to be socially out there, and I'm sure a lot of you do too. So this presentation is a California federal tax update focusing on the new issues of the day overall, but also focusing on things that were impacted by COVID in particular. So we'll be talking about, it's going to be exciting, by the way. This is an exciting presentation. We don't have Bruce Springsteen or anybody coming on, but I think we're really this is gonna knock your socks off. This is a real exciting presentation. The individual side, we're gonna be talking about law changes primarily, and then going over some rate issues and things like that. But finally, we're gonna be talking a little more in the future context. We're gonna be talking a little bit about what we sense might be coming down the road with the Biden tax proposals. They're all proposals at this point, but we'll certainly be handling those in detail for you and give you some idea of what lies ahead. Then we'll go into the Paycheck Protection Program, the PPP. I've said PPs more times lately than since I was 5 years old, I think, but the Paycheck Protection Program was expanded in December again with a new round. In order to explain the new round, and also for people that haven't been at these presentations before, I'm going to take the opportunity to go through all the basic elements of the Paycheck Protection Program one more time, and highlighting the new PP2 element of the most recent legislation. Then we'll go into business changes, largely triggered by COVID, that might be a great opportunity for people out there that have business situations that need tax planning and strategies. And if we have time, I'm trying to get all this done in a little more than an hour and 15 minutes, is retirement. We're going to talk a little bit about retirement, which essentially flowed from the Secure Act that was passed at the end of 2019. In the past, we've come close at the end. I invite you to send questions in, but I promise if we don't have time to address them, Monique makes them available to me after the presentation. I try to get back to people as soon as possible. And sometimes it's easier for you folks to kind of gather your thoughts and send them in the form of an email or something. I'd be happy to respond any way we can. So here is the legislation that will be triggering what we're talking about. As I said, the Secure Act was passed in December. That's mostly about IRA changes and things like distributions and required minimum distributions. Then we had the big one, the CARES Act, that was in late March. We spent at least a couple of presentations here going through. It was a blockbuster piece of legislation that came out fast, and because it was fast and hurried, it was flawed, to say the least. It was a bit of a dumpster fire, frankly, which triggered the Paycheck Protection Flexibility Act, which was the act that was meant to fix some of the uncertainties and errors in the CARES Act, expand it to make it available to more people, and that was in June. And then there's no real good acronym for this. It's ACRRA. I'm just going to call it PPP2. That's that December act that expanded and added a new round of PPP funding and also had a new stimulus check element to it. So that's the focus of what we're going to be talking about. On the individual side, first, the stimulus payments. So there's essentially three elements of this that we need to understand. And we've discussed the first two, but we need to address what's coming down the road. The stimulus payments, big part of the CARES Act. It was that $1,200 check that they were trying to get out fast. They got it out so fast that there were errors in the way they deployed it. But the key thing to know on those stimulus payments were their advances. They are advances. They're advances that's going to be reconciled on your 2020 tax return. Well, it was in the year of 2020 that they were doing the advances, so they really didn't know from a qualification standpoint exactly who was going to qualify. So they based it on your 2019 tax returns or your 2018 tax returns. If they didn't have that, they went to your Social Security statements to determine whether your income level, which I will get into in a minute, allows you to qualify for the credit. The credit was $1,200 per individual, $2,400 for a married couple, and $500 per qualifying child, which at that point was defined as under 17. Important distinction to know. You know, these stimulus check things seem maybe small, but they're not going to be small if you consider them in totality. And if you don't qualify, maybe your friends will. The newest round of these stimulus payments are going to have a much larger amount allocated to qualifying children. The definition of qualifying children will be expanded to dependents. So we'll be getting into that. But here are the income levels. So the key number is $198,000 if you're married. That's the threshold where you qualify for this credit. As I said, it's an advance. So when you do your tax return in 2020, maybe you are just beginning to think about that. If your income turns out to be more than that, and you got the advance because it was based on the prior year's tax, you don't have to refund it. That's the key part of this. It's good for tax planning when we talk about the upcoming stimulus in terms of when you file your tax return. But that $198,000 is the key number. It's a phase out between 150 and 198. So the act that passed at the end of the year, the ACRRA Act, PPP2 is what I've been calling it, added yet another round of stimulus payments as well. That was an amount that was debated. You might remember during the election that it was ultimately $600, but both Pelosi and Trump wanted it to be at some point $2,000. it was $600 per taxpayer, with another $600 for each dependent. That one was based on your 2019 return because the law was passed in December. They already had your 19 information. So at this point, you've got the $1,200 twice, and you've got the $600 twice if you're married, plus your dependent exemptions. And then here are the thresholds. They're slightly different for PPP2. As you can see, the thresholds are slightly lower in terms of who qualified. So those are the first two stimulus payments. There's a third round that's right now in the hopper. That's what they're debating right now. By the way, if you're following the news, what they are debating, that $198,000 number there, that's what they're debating. What should that threshold be for people to qualify for the stimulus payment? There were also disaster relief payments in the CARES Act for unexpected expenses, unmet financial needs, large campus operation type things, school type things. They are not taxable income. They're considered disaster relief payments. So unlike the sick leave provisions that came, which are considered income type items, these are not taxable, these disaster relief payments. Paid sick leave is taxable. So that's a distinction. If an employer provides funds to its employers to help the employee meet living expenses due to a stay-at-home order, those payments are deductible by the employee, excluded from the employee's income because those are considered disaster relief. Sick and family leave payments are considered as wages. There's a small distinction there. There was other emergency financial aid grants incorporated into the CARES Act, though they are primarily related to education, as I said, and they're excluded from the student's taxable income. They're not like scholarships and other education assistance type programs, which may sometimes be taxable. So that's another potential positive element to the taxability of those payments. So just some reminders from the 2017 Tax Act. The whole result of that act for our California taxpayers was that you lost your personal exemption deductions for your dependents. That was a loss. So you lost the exemptions, but you gained a larger child credit, and you also had lower rates. The highest rate went from 39 to 37. Now, right now, for the returns you're about to do, the exemptions are still out. You still do not have the dependency exemption. California has a small exemption credit that was not affected by that legislation. Who has to file a tax return? I get that question a lot from my clients about their kids primarily. It's a little simpler now. You base who has to file on your standard deduction. The standard deductions are much larger now. So that's roughly $24,700 before you would have to file a tax return. If you're self-employed, you have to file a tax return if your net income is over $400. If your children in particular have income below that, you don't have to file a tax return for them, but they may have withholding from their summer job or something like that. So it still would be a good idea to file a tax return to get that money back. The kiddie tax rules, a horrible name for legislation, a kiddie tax. It seems awful, but the kiddie tax was in play up until the 2017 Act. That's a tax that basically for children who have unearned income over $2,200, it was prior to 2017 taxed at the parent's rate. It is now taxed at the child's, for the 2017 Act, that was changed. And the amount was, the tax rate was based on trust rates, which were higher, but you didn't have to go through the process of filing a tax return, a separate tax return. The parents didn't. The old kiddie tax rules are now back, which means that kids do have to report that income on their tax return, or the parents can report their kids' unearned income on their tax return, but at their tax rates. So the tax impact is better, but the execution and is a little more difficult to do. So that's the kiddie tax. So I've got a signed out thing. Do I hit this? Let's see. No, I'm not sure what that is. So hold on for a minute. I've got a little flaw in moving forward on the presentation. So let me get my assistant. I'll be right back. While he's doing that, I'm going to keep going with the presentation. After the kiddie tax, the capital gain rates. So everybody asks me, what is the income level where the capital gain rates kick in at the higher bracket, the 20% bracket? And we're back. So that threshold is presently roughly $500,000 when the 20% rate kicks in. So that doesn't change much between 2020 and 2021. That 15% bracket, therefore, for all capital gains is up to that $500,000 break point. After $500,000, the rate goes to 20%. We got to keep an eye on these rates because they may change with the new tax, with the Biden propositions, which I'm going to be talking about in a minute. But an important headline there or note is that 0% bracket. So if you're not working during a year, or you know someone who isn't working, you literally could trigger capital gains up to $80,000 and have it taxed at a 0% rate. Now that's good news, although I've had clients misinterpret that. I had a client a couple of years ago come in and say, I understand if my taxable income, I didn't work this year. I took a trip, so my taxable income is under $80,000. What is my, and I understand it's a zero tax rate, so I sold my house and I have a $2 million gain and it's taxed at 0%. I said, well, you know, fasten your seatbelt, only up to 80,000 is taxed at the 0% rate, which didn't go over too well. I have clients throw things at me, and that's one of the ones where they threw something at me because they just realized they had $1 million of gain tax that they didn't expect. But that said, there is a 0% bracket up to $80,000. There's also a 3.8% Medicare tax if your income is over $250,000. So it's likely if your taxable income is over $496,000 that you're really paying 23% on your capital gains at that point. Alimony is no longer deductible and it's no longer income to the recipient as of divorce decrees after December 31st, 2018. Prior divorce decrees are grandfathered in. California does not adhere to that rule, so you could actually have a separate number on your tax return for the taxability of alimony and the deductibility of alimony. Student loan payments made by employers. I'll just handle this quickly. We're seeing a little bit more of this where payments by an employer on an employee student loan that are made after March 27th. This is really as a result of the CARES Act. Those payments are excluded from the employee's gross income. It's like a cafeteria plan or 125 plan, up to $5,250. That amount is not included in the recipient's income. So it's just another element of, you know, you typically have a Section 125 plan to handle medical, unreimbursed medical, and student education and childcare. Now you can add student loan payments made by employer as well. Another item that triggers files being thrown at me by clients is the deductibility of tuition. They always say you get a Form 1098-T from the educational institution saying this is the amount, and then there are huge amounts, as you know, that you paid in tuition, and they say, hand me a $60,000, a 1098-T with $60,000 and hoping that a large part of that might be deductible. And I have to tell them that it's only deductible up to $4,000 and only if your income is between up to $160,000. Again, duck when I tell people that. I was hoping that new rules may expand that, but I don't see it coming down the pike right now. HSA still are in play. The amount keeps going up each year. The HSA amount for 2020, well, the contribution limit was $7,100. There's a catch-up amount of another $1,000. And it has to be a high deductible plan. So it's a max out of pocket of $13,800 for those. And those will continue to go up. California does not have an HSA deduction. So you'll have a difference between your federal and state return if you are in an HSA. As I said earlier, the standard deduction went up quite a bit a couple of years ago. It's $24,800. So if you don't have a mortgage, and your state income taxes, as we know, are capped at $10,000 now as a deduction, some people who have less than $14,000 of donations may, in fact, not itemize their return. They may take the standard deduction. It's a simpler presentation in your tax return, but it's sure a different world than the one that we were used to before, where most everybody itemized. Couple updates on mileage rates. The medical mileage rate, if you're driving to a doctor for deductibility, is 17 cents. You know, there's a threshold of when you can deduct medical expenses, so it may be a moot point. The threshold for medical expenses is 7.5% of your AGI before you can deduct the medical expenses. And California uses a different threshold for their medical expense deduction. Long-term care insurance is still deductible up to $5,430. That number keeps going up. When you're self-employed, always go and find all of your insurance that you paid out of pocket, because that's a self-employment insurance deduction. It's more like a business deduction for those people, not subject to the medical deduction limitations. So keep that in mind. I always want to talk to my clients about this, which is if you have parents, or sometimes it might be you, that are considering going into a retirement community, a lot of those buy-in scenarios for retirement communities break out the payment that you're making on those lifetime care contracts. And they have an amount that's in there that's really about ongoing lifetime care for medical. If they break that out, and most quality institutions are now, that becomes a deductible medical expense. So when you get those, and we've all heard the horror stories about how much these amounts can be, do a deeper dive and find out if the retirement community has provided information on the breakdown of your entrance fee as to whether or not some of it is medical. You might be able to have a huge deduction the year you enter, which also may be a great tax planning opportunity, because if you don't have much income that year, that might be a year to basically roll an IRA over to a Roth or something like that to trigger income to offset that large medical expense. What is deductible for mortgage interest? Up until 2017, it was up to $1 million in debt, plus another $100,000 for what we call home equity debt secured by your home, but used for anything, cars or anything else. That number, as of 2018, was reduced to $750,000. And it's an important number in California in terms of what's the threshold where you can continue to deduct the interest. You have to prorate your interest deduction if your number goes over that $750,000. If you had a loan in existence prior to the end of 2017, your old $1 million threshold is grandfathered in. Home equity debt is not grandfathered in. You've got to break that part out. That is no longer deductible, period. I want everybody that's listening to this, if you're self-employed, to just at least know the term QBI, Qualified Business Income, QBI. Talk to your preparer. Just make sure that the term QBI has been addressed on your tax return. It came in the 2017 Tax Act. I've given presentations on it. It's a presentation in of itself to go through it. But the rough outline, the things you need to know, is that if you are self-employed or you have pass-through income from a partnership or an S corporation, that is qualified business income, QBI. You may very well be able to deduct 20% of that number against your income. There are limitations. It's limited to 20% of your taxable income. And it's also limited in terms of what kind of service you're providing. If it is a specified service, like an attorney or an accountant, you can only take that 20% deduction up to $420,000 of income. If you're not a service industry, you will be able to take that 20% deduction even above that amount, as long as you're paying wages or have assets in your business. This is why you might hear, if you're self-employed, the concept of maybe I should form an S corp to potentially unlock this QBI deduction. If you do that, the wages that you pay yourself in that S corp qualify as a deduction that unlocks the QBI deduction. That's all we're going to say about QBI, other than know it exists. Ask your tax preparer about it. It's a potentially very, very beneficial deduction for people who are in business for themselves. The child care in the pluses and minuses of the 2017 Act, I told you that the dependency exemption went away, but child care credits went up to $2,000. More importantly, the old rules, the people that could get a child credit was at a fairly low adjusted gross income amount. That has been increased to $400,000. So most taxpayers qualify to take the $2,000 child credit for the qualifying child, and that's the 17 age range for this particular credit. The one thing I want to point out on energy credits is that they have expanded, or at least the period of time where you can take the solar property credit. There are other small energy credits for windows and things like that. But the one that's a big one is if you do solar. If you do a solar, what they call residential energy efficient expenditure. Solar, as long as it's not for a hot tub or a sauna, you will get a credit of 26% of that expenditure without a cap for amounts that were spent between January and the end of this 2021 for those expenditures. It'll go down to 22% the next year. It's a credit. It's a direct reduction of your tax. Most of my clients that did it, that did solar, found this to be the thing that made it a winning economic proposition when they did it. That's the solar energy credit. So we know that the Affordable Care Act, which was passed during the Obama administration, a part of it, the shared responsibility payment for individuals, was repealed. Individuals are no longer required to have insurance from a tax perspective, but the state of California still has the individual mandate. The state of California still has penalties if you do not have health insurance. The penalties are based on your income level as vis-a-vis the poverty line. So there is, I just want to point out that we're not completely home free in terms of those of you who do not have health insurance. If you're in a higher income area, maybe being subject to a penalty or what they call a shared responsibility payment when you file your state tax return. An important note is that the U.S. Supreme Court is currently debating California versus Texas. That's about the entire constitutionality of the Health Care Act. If that passed, if that was to be repealed without other provisions, the entire the Health Care Act, including things that had been taxed before, that 3.8% rate that we talked about, could potentially be subject to a refund. It's such a huge number that you'd have to be dubious that that could happen, but you have to be mindful that that's out there right now in the law. The nanny tax still exists. If you pay, it's not just nannies, it's a terrible word for a tax, the nanny tax, but it's for any kind of in-home care or assistant. It's $2,200 is the amount where you have to start filing tax forms, holding FICA, Social Security for that person. People that have that amount usually use a payroll service to do a Schedule H because you do have to report that on your tax return. The reason I bring it up is that with the COVID, a lot more people have had tutors and people providing training for distance learning in-house. Those people could be subject to having to file this form for the nanny tax. Sorry to say, but it's important for you to know that. The 529 plans that you've heard about over the years, and many of you have them, are typically for college expenditures. Now they've expanded to K through 12 as eligible expenditures that qualify for a 529 plan. 529 plan contributions are not deductible, but when you pull the accumulated funds out of your 529 account, they're not taxable. So what can we expect from President Biden? You know, during the election, taxes were not a huge part of the debate. COVID was a larger part, but this was part of his core package and the platform of the Democratic Party during the convention. And the keys are the following. They would repeal that, they would expand the highest tax bracket from 37 to 39.6. So Obama had it at 39.5, then it went to 37. It might go back to 39 for the highest tax bracket for those earning over $1 million. For those over $1 million, this is important. The proposal was that capital gains for those people that earned over $1 million would be taxed at their marginal tax brackets of 39%. In California, again, with huge capital gains, that could be a big deal. Again, this is just a proposal, but I want you to know what's out there. That 39% tax bracket increase would be for those earning over $400,000. That QBI deduction that I talked about, which has been so powerful, it would still exist, but it would be phased out for those with households of taxable income over $400,000. And they may create a donut hole on Social Security. Remember, you pay Social Security up to $139,000 on your W-2, and then it goes away. The proposal is that for those between that number, it's actually $137,000 and $400,000, there would be no Social Security, just as there is now. But for those over $400,000, the Social Security might kick back in. So we have to keep an eye on that. Itemized deductions in totality may be limited in the new rules. The one I want to emphasize the most, the one we're keeping our eye on the most, is the proposal that they may repeal the step-up in basis for inherited properties. Again, in California, this is a huge tax issue. If your parents have property they bought in the 60s for $50,000 and now it's worth $2 million, when you inherit that property, it gets stepped up cost basis wise to $2 million. Should you sell it a month later, you would not have capital gain. If the step up basis was repealed, it's potentially that huge amount of appreciation may be subject to tax. The carryover basis may be repealed. So this is what we have to keep an eye on. It's, again, just a proposal. I don't even think there's potentially 50 votes in Congress to pass it, but it's out there. An increase in corporate tax rates from 21 to 28% was also in the provisions. The energy credits were expanded in these proposals. The ABC test for workers, you might have heard of that in California. Whether you're a subcontractor or an employee was determined by this new ABC test. There are exemptions for realtors and a lot of other people, but the proposal under the Biden rule would be that the ABC test might be a national test. What it really means is that for some people who are right now subcontractors, if they have a level of control of their work, they may have to be reclassified as employees if that was to happen. They would reestablish first-time home buyer credits that could be large. They would expand the earned income tax credit. As I said earlier, these are changes that are probably down the road with the stimulus bill that's currently underway. That's a much more significant part of his plan. And that's the American Rescue Plan. That's this $1.9 trillion stimulus package that's currently out there. It would supplement payments that have already been made, that $600 payment, with another $1,400 stimulus check to get it to that magic $2,000 number. Here's the important thing about this. Remember, the kids element of the credit on the first two elements of the stimulus package was $600. Kids would also get a $2,000 credit under this provision. So it's potential that a husband and wife and 3 kids could have a total of $1,400 times 5 more in tax reduction when this stimulus bill is passed. And what they're debating right now is what level of income before you would get that $1,400. But there's really what they are debating is potentially a significant reduction in taxes for those people because of the expansion of who qualifies for this stimulus payment. They're also going to extend the required family leave if the Biden proposals go into play. Quick term reconciliation. That will determine whether or not these rules get passed. Reconciliation is a tax law that says you only need 50 votes in the Senate to pass this type of legislation, as opposed to the supermajority 60 votes that you require for other legislation. If it's a budgetary matter, you can use this reconciliation approach. You can use it, there's a debate about how often you can use it, once a year, twice a year. It looks like they're going to use it for this Stimulus Act, which may lessen the possibility that those other provisions of the Biden rules will pass because they will not be able to use reconciliation again. So we just need to keep an eye on the method that they pass the new rules. And they're talking about expanding the child credit as well, and some small business relief. The Paycheck Protection Program. There was PP1 and now there's PP2, a brand new expansion of the program. History, the CARES Act passed, the original CARES Act passed the $349 billion Paycheck Protection Program. That's the one we discussed in March. The subsequent legislation expand the period of time from covered period for this bill from 8 weeks to 24 weeks. The key to the bill was that the loans would be forgiven if you use the funds for the areas that payroll protection, rent, or other types of expenses that were qualified under the Act. If you met those constraints, you would get the full amount of the loan forgiven. As I said, there were a lot of holes in the legislation, so they passed the Paycheck Protection Program Flexibility Act. That's the one that expanded it from 8 weeks to 24 weeks to get people covered, which really meant most people fell within the parameters that allowed you to completely have the loan forgiven. What is the amount of the loan? The original amount of the loan was 2.5 times your average monthly payroll costs, up to $10 million. We didn't at the point that the first law passed know what the definition of payroll cost was clearly. We now know that payroll cost is the amount from your 2019 payroll. So that's the amount. You take that amount, divide it by 12, and multiply it times 2.5. That was the amount of the loan you could qualify for, up to $10 million. The new act, the new PPP2, the new bill expands and adds a new $284 billion amount of PPP loans. So we've had PP1 for 348, then the additional amount of another 328 billion, and now they've got another 284 billion for a total of $960 billion made available to business for these loans that can be forgiven if you spend them on payroll in the normal course of business. And there's some other expenses that you can spend it on. The new second draw loans are for smaller businesses with gross incomes who have dropped. They have a more defined definition of who qualifies for this, which I'm going to get into. The supplemental, so the new act, which changes who qualifies and allows people that had what is called an employee retention credit, which previously, if you were applying for an employee retention credit, which I'm going to discuss a little bit later, you couldn't do a PPP loan. The new law says you can now do both. You can now do both. And not only can you do both, if you have not filed for forgiveness yet on your first loan, you can go back and revise your first loan to expand it to meet these new, more liberalized rules. So that's really important. Not only did they add a new round of funding, but they expand who qualified for the funding and made that expansion available to those who had the old loans. This is, I'm going fast, but this is that the maximum amount for the new loans is $2 million per eligible entity. Other changes are for employers who have no more than 300 employees. In this case, they are more specific on who qualifies. You must have at least a 25% reduction in your gross receipts in the first, second, and third quarter of 2020 relative to the same period in 2019. This is for the new PP2 loans. If you meet those constraints, you would qualify for a new round of funding. I always get asked who qualifies if you're self-employed for these PPP loans. And it wasn't clear when the first law came out, but they have clarified it now. It's pretty straightforward. If you have a Schedule C on your tax return, or you're self-employed another way, you go up to $100,000 of net income from that activity qualifies for the loan. Remember the math. You take that, you divide it by 12 to get your monthly amount, and multiply it times that 2.5 ratio. That gives you roughly a $20,800 loan that a self-employed person could have gotten and could continue to get in this new provision on the PPP2. $20,800 is the amount a self-employed person could qualify for. If that self-employed person has employees, you can include them in your calculation and expand that $20,000 amount. So I get asked this, how do I revise that first loan? Who qualifies for the revision of the first PPP loan? Borrowers can also submit supplemental PP loan requests in all cases where their original PP loan amount would have changed due to the new rules. This applies to partnerships where the original loans did not include the self-employment earnings of partners. There are some other people that qualify for it too, but this third one is the most important, and I mentioned it earlier. The new supplemental funding, it applies to borrowers that return their original loans or took reduced loans in the original PPP loans for benefits that are no longer limited under the new PPP guidelines. The employee retention credit is the biggest one. I'm going to discuss the employee retention credit when we get into the business section, but you can now do both. You can't take the expense for both, but you can have an employee retention credit in your portfolio and also do the PPP loan. Borrowers must request this additional funding before forgiveness is granted on their original PPP loan. This is what I get asked a lot. What's the cutoff? I've got an original loan. I'm done with the loan. My question would be, have you applied for forgiveness yet on that loan? The borrowers, to get the first loan revised, must not have received forgiveness on that first loan. So borrowers that may want to borrow additional funds should wait to apply for forgiveness and attempt to withdraw forgiveness applications that have already been submitted. Therefore, you can resubmit on those, get the amount of the first loan expanded, spend those funds. When that's forgiven, then you can go into PPP2. That's the mechanics. The loan terms are based on 2.5 times the borrower's average monthly payroll, just as the original ones were based, but they've expanded the definition for restaurants and people in the hospitality industry. Remember, it was 2.5 times those monthly average costs, the amount of the loan. It's now 3.5 times those average monthly payroll costs for restaurants in particular. So a PPP2, if you're a restaurant or a hotel, the amount of the loan could potentially be larger, up to a maximum of $2 million. How do you get the loan forgiven? You're going to submit a form. It's a 3508 form is what you submit. And what that form does is explain that you have, in fact, used the funds for the appropriate payroll purposes. You must apply for loan forgiveness within 10 months after the last day of the covered period, which is between 8 and 24 weeks. What is eligible for forgiveness? Payroll costs, mortgage interest, rent, utilities. But the payroll cost component must be at least 60%. If not, the amount of your forgiveness will be reduced. Payroll must be 60%. The expenses under PPP2 have been expanded. The definition of what a qualified expense has been expanded. It includes business things that were required to facilitate business operations, the processing payment of payroll expenses, human resources, accounting for the tracking of supplies, inventory records, property damage, things that were damaged as a result of public disturbances. The one that's created the most interest, covered supplier costs, amounts paid to a supplier for goods essential to your operations. This is a much larger definition of a qualified expense for the PPP loan. Those would qualify. Other qualified worker protection expenditures for things like drive-through window facilities or physical barriers, things like that. Those all qualify. Health screening sites qualify. Remember, these are the new rules for the new PPP2, but they also apply to the old loans. If you have not applied for forgiveness yet on those old loans, you might be able to adjust those old loans to expand your qualified expenditures and maybe get more forgiven. That's the point. As I said earlier, the forgiveness period is 24 weeks. The earlier of 24 weeks or December 30th, 2020 on the old PPP loans. The new is expanded to September. The new covered period, there's a little more flexibility in what you can use as a covered period. You can choose a covered period between 8 and 24 weeks. What is this all about? What this is about is the question we had for people that were maybe able to satisfy the rules, but weren't sure how many of those rules will be adhered to for the full period? Will I be able to keep everybody? Things like that. You have a little more flexibility now in choosing your covered period. Because loans are based on 2.5 months of payroll costs, this is important, spending the full amount during that original 8-week covered period in the original law was basically impossible. My restaurant clients would come in and say, well, I've got this loan for $1 million. I can get it forgiven if I use 60% of it for my employee's payroll, but we're forced to be closed. We can't make it under 8 weeks. That was that Flexibility Act. The Flexibility Act allowed them to expand from 8 weeks to 24 weeks. That 24 weeks was typically enough for people to get that full amount forgiven, unless there was something like this, the business was completely closed or something like that. And for situations like that, there are a number of safe harbors that allow you still to meet that threshold. The payroll costs can only be up to $100,000 per employee in terms of what can be forgiven. There's some additional definitions of what are payroll costs. Payroll costs include retirement benefits. They include health care. Again, up to $100,000 of payroll per employee. That's when you do the forgiveness form, that's what you're filling out. How much per employee were my payroll costs? Payroll services are helping people fill out those forms, but that's what it's all about. That's the most complicated part of the whole process. The maximum compensation impact is that a loan for each employee was roughly $15,300 that could be forgiven. With the new 24-week forgiveness period, you've got this $900 to $1 million loan. You could have $46,000 per employee forgiven based on the new 24-week period. That's how important expanding it to 24 weeks was for the whole rule. So that's important. For an owner, you can only go up to $20,833 is the amount that you can get forgiven. $20,833. There was a huge question for my clients who are very strategic, and they said, well, apparently retirement benefits count as a qualified expense to get forgiven. What if I just lump all of my retirement benefits from the prior year and pay them all at once during the covered period, and therefore get all of my loan forgiven? It was not very clearly addressed in the original PPP. The new PPP guidelines that came out later explained that retirement benefits could not be accelerated, that the forgiveness does not apply to retirement or health benefits accelerated into the covered period. Only the amount of benefits proportional to the covered period qualify for forgiveness for retirement benefits. So that idea of accelerating, getting this big chunk from a whole prior year doesn't work under those provisions. It makes sense. What are non-payroll costs that qualify? The 40% costs. They must be, first of all, paid during the covered period. What is paid? It means incurred during the covered period or paid on or before the next regular billing date, even if the billing date is after the covered period. A very liberal definition of what constitutes a qualified expense. Paid during or one billing period after. So you can accrue some expenses going in and pay it during the covered period. And you have one other period that also gets included in the period. What triggers a reduction in how much can be forgiven? You have to retain your full-time employees up to a certain level. And you also have to maintain a certain pay level. How do they measure whether you've maintained it? You measure what you had as employees or what you paid in salaries during your covered period and compare it to your reference period from 2019, typically, to maintain your employee level and or your salary level. But as I said, there are a number of safe harbors if you can't meet that rule. If you are unable to rehire employees, even though you made a good faith effort to rehire them, you will get a safe harbor and not be subject to basically having your forgiveness reduced. You must keep the good faith offer to your employee on hand to prove that that actually happened. If they were fired for cause, that doesn't cause a forgiveness reduction. If your business activity, the incidents that I talked about before, if you're a restaurant, you've been forced to close due to the guidelines of the CDC, or Health and Human Services. Those employees that you were not able to retain are not subject to the what we call the clawback, or the reduction in your forgiveness. So there's some real liberal rules in terms of getting that loan forgiven. Finally, on the PPP, the huge issue that was not really addressed until the very end of last year. We know that the income from the PPP, the loan itself, is not taxable. It is not taxable. But when you use those funds and pay your people or do your utilities, are those expenses deductible? Because those funds came from the PPP loan. The IRS in September of last year shocked us by saying, no, they will not be deductible, which significantly impacted the value of the loan itself if you couldn't deduct the use of the funds. PPP2 Act gave us real relief. It said that no deduction may be denied, no tax attribute can be reduced, and no basis can be increased or denied by reason of any PPP loan forgiveness. What does that mean? It means the expenses that you paid for with your PPP loan are deductible. It's the win-win issue that we were always hoping for. The loan itself is not taxable. How you spent the funds is deductible. Problem, California. California has not conformed to the deductibility provision. As we speak right now, they are not deductible in California. You would have a potentially significant difference between your federal and state return by not being able to deduct those expenses. I've got to tell you, we've been monitoring legislation and seeing if California will ultimately adhere to the IRS. But the problem was California actually passed a law in the middle of 2019 that said the income was not taxable, but also said that the expenses were not deductible. We need them to change that. Otherwise, you're going to have a big state federal difference on your taxes for the PPP loans. Maybe the most significant thing we've talked about on the PPP loans. On the business side, so we okay, believe it or not. On the business side, a couple of items of relief from the CARES Act and then some of these subsequent acts. There was a delay in employer payroll tax payments. You were allowed mandatory paid sick leave and getting the credit, the employer was getting the credit for the amount that they paid, the same for family leave. And there was the aforementioned employee retention credit. We're going to go through those now in a little more detail. Businesses may defer the employer's share of Social Security tax at 6.2% for the period March 7th, 2020 through December 31st. The employer's share of FICA could be deferred. 50% of it would be due at the end of 2021. 50% would be due at the end of 2022. Significant relief for employers on their employer's share of Social Security tax. The ultimate payments will be made either electronically or on your 941 forms down the road. Here are who are the eligible employers for that ability to defer. Then, subsequent to that, the employee side was addressed. The IRS permitted employers to defer the withholding, deposit, and payments of the employee's portion of Social Security tax. They're not required to withhold the employee's portion of Social Security tax, even if the employer requests the deferral. However, if the taxes are deferred, the employers must withhold and pay the deferred rate ratably from wages and compensation paid to the employees, and the applicable period here is September 1st, 2020 to April 30th, 2021. And the repayment period is May 1st, 2021 through December 31st, 2021. And there are some expansions of these deferrals with the most recent act, but the point is both the employer and employee Social Security amounts could be deferred to help cash flow. The mandatory paid sick leave was passed under the CARES Act, or an act that happened just nearby the CARES Act in March. The mandatory paid sick leave and rent and leave act is the FFCRA Act. It expires on December 30th, 2020, but as I said, there's going to be some expansion of it in some of these new proposals. The employers are no longer required to pay these benefits after December 31st, 2020. But if they do, they're still going to be entitled to that credit. Remember, when you pay the sick leave or the family leave, meeting the provisions that I'm about to discuss, you get a credit on your payroll tax returns for the amount you paid. It's not required that you do that after December 31st, but if you do it, you will still be entitled to the credit. It will be in essence reimbursed. The definition of paid sick leave, which we covered in 2 prior presentations, but from April 1st, 2020 through December 31st, 2020, employers with fewer than 500 employees must provide up to 80 hours of paid sick leave to each employee unable to work. For an employee who was unable to work because of the coronavirus quarantine or self-quarantine and was coronavirus symptoms and is seeking a diagnosis, the amount is the regular rate of pay up to $511 per payday and $5,100 in the aggregate for a total of 10 days. It's a different amount for an employee who is asking for paid sick leave for caring for someone else who has coronavirus or is caring for a child. The amounts, as you can see, are reduced to $200 a day, $2,000 in the aggregate, up to 10 days. That's paid sick leave. Again, employers will receive a refundable credit for the amounts they pay to the employees. An additional credit determined based on the cost of maintaining health insurance for those eligible employees can also be added to this mix. I don't have it in my presentation, but remember that the mechanics became clunky because when these businesses were distressed and still paying the sick leave, they were going to have to wait until their payroll tax returns to get this credit, to get this reduction, to have it reimbursed. A form was developed, a form 7200 was developed that an employer could submit right away and have the credit come back much quicker than waiting for your payroll tax returns. The paid family leave is a little bit different rules. It allows employees who have worked more than 30 days for an employer who employs fewer than 500 employees to take up to 10 weeks of employer paid family leave. There are some different requirements for paid family leave, but the key is it's 10 weeks for paid family leave, a total of 12 weeks if you add the sick leave. And again, to the extent you pay the family leave, it comes back as a credit when you do your Form 941s, your payroll returns. Again, the credit is 100% of the paid sick leave and the paid family leave. And there is an increase in the reimbursement for the employer's qualified health plan expenses applicable to the paid sick leave and the family leave. Okay, the employee retention credit, the ERC. Let's get into this. And let's discuss it, not just in the context of what it is, but how it's been impacted by the most recent legislation in December. The CARES Act provided a refundable credit against quarterly employment taxes equal to 50% of qualified wages. 50% of qualified wages. Only wages paid after March 12, 2020 and before January 1st qualify for this 50%. The maximum qualified wages per employee for the original ERC was $10,000, which equates to a maximum credit of $5,000 per employee. There is no maximum number of employees who may lead to the credit. The ERC is in addition to the payroll tax credits available under the sick leave and family leave. So you could literally have 3 credits offsetting your payroll taxes. But when it first came through the ERC, we made note to people that you can't do a PPP loan and have the employee retention credit. You can't do both. The new rules changed that. But before I get into that, who is eligible? Anyone carrying on a trade or business during the 2020 calendar year. It's respect to any calendar quarter, and it's for calendar quarter. This is the original ERC. If you are fully or partially suspended in your operations, or you experience a significant decline in gross receipts. Those are the people that qualify for this large credit. What is a significant decline in gross receipts? 50% for the same calendar quarter the prior year. That is the original ERC rules, 50%. If the gross receipts are less than 50% of the gross receipts for the same calendar quarter, then the ERC is available for the entire quarter. An employer can claim the ERC through the end of the first quarter, for which its gross receipts are greater than 80% of the gross receipts for the same calendar quarter in 2019. So you were measuring it quarter by quarter. But the important thing in the original ERC is it was a maximum per employee. This has all been expanded under the new act, the PP2 Act. It modifies, expands, and extends the ERC. Critical, one of the most important things we've discussed in the presentation. Wages paid with forgiven PPP debt are not included in payroll costs taken into account in computing the ERC, but you can have both. So this requires us to coordinate the two. And I want you to think a little bit about this, and it makes sense. Under the CARES Act, PPP loan recipients were ineligible to claim the ERC. The new act retroactively repeals this rule. Under the new act, a PPP loan recipient may now claim the credit, but you can't take the expense on the ERC and also have to qualify for the PPP loan. So analyze it, think about which one do you want, because you might be able to go back and expand your ERC if you haven't applied for forgiveness on your original PPP loan. If you've already, good example, is because of the expansion to 24 weeks, if you've already used all the funds and plenty more to qualify for the loan forgiveness for payroll potential, maybe you should carve out some of those payroll expenses and not apply them to the PPP loan and use them for your employee retention credit instead and get the benefit for both. That's the things you have to analyze. Which is best? Overall, if it's a choice between the PPP loan and the ERC, you will take the PPP loan because it's completely forgiven and not taxable, and the amount spent is deductible. But as I said, it's silly if you've already used all your PPP loan funds to not do the ERC because of those same expenses. Just carve out an amount and use it for the ERC. Send me questions if you have it on this, because I'm seeing a lot of people confused about all this, and it's hard to explain in a 1 and a half hour presentation. But I just want you to know that the ERC and the PPP are available, both available now, but you have to really navigate and finesse this to get the maximum benefit for both. The credit extension and expansion of the ERC has some different definitions. First of all, it expanded the ERC from December 30th, extends the credit to apply to qualified wages paid prior to July 1st, 2021. So now it applies to wages paid after the March 12, 2020 through July 1st, 2021 period. It increases the credit. Remember, it was 50% of qualified wages. It's now 70% for the second period. It increases the 10,000 qualified wage limit to apply per quarter. It's now on an annual basis. So you could meet this on each employee, each quarter, 10,000. If that person was making $12,000 a quarter, say, you could get 10,000 one quarter, 10,000 the next quarter, 10,000 the next quarter, instead of just being limited to the $10,000. It's expanded through June 30th, 2021. So the definition of what qualifies has been expanded, the period has been expanded, and the fact that you can take both the ERC and the PPP loan is a very much of a liberalized definition of the rule. The eligible employers has been expanded. For calendar quarters beginning after December 31st, 2020, the PPP Act amends the CARES Act and adds a significant decline in gross revenue revision. For such calendar quarters are less than 80% of gross receipts of such employer for the same quarter. It was 50%, it's now 80%. So that's only 80% of the gross receipts test. So it's easier to meet this test. There's some amendments if you weren't, some provisions if you weren't in business at the beginning of the calendar quarter in 2019, and employers with less than 500 employees are now allowed for the credit. So a couple other things on the business provision. We're doing pretty good on the timing. These are, if you are in business, these are largely from the CARES Act. Some of these were from the last act that just passed. So these are some of these logical things that they try to expand. I'm going to try to explain them in more common sense terms. because there are very countish type definitions here. But if you're a business suffering from COVID, in 2017, the net operating loss rules were made less beneficial. The losses arising for tax years beginning after December 31st, 2017, the NOL deduction, you have a loss from your business. We used to be able to take that business loss and carry it back 2 years, amend a return, and get prior taxes paid refunded. You get the benefit right away from that loss. Or you could carry it forward 20 years. That was the old rule. In 2017, that rule was reduced to no carryback. And only 80% of the taxable income would be allowable as to be offset with the NOL loss. So it wasn't as beneficial. The CARES Act, seeing that people that were generating losses that may have paid taxes in prior years, you wanted to create a way for them to go in and reach back and get some of those prior taxes paid by applying for this carryback. So now they've reinstated a more liberalized carryback. A 5-year carryback are allowed now for NOLs incurred between 2018 and 2020. The 80% taxable income limitation I just discussed is suspended for 2018 through 2020. This means that taxpayers can retroactively go back and use their 2018 and 2019 NOLs and carry them back 5 years to 2013 and 2014. So if you're a person suffering or have been suffering the last couple of years, but you have a pattern of paying taxes in the prior years, talk to your practitioner about going back and applying for these NOL carrybacks, which will refund some of the prior taxes you paid. That's the NOL loss revisions. This is an existing law, but all people in business should know the term 179, Section 179. If you're self-employed, you should know this too. You can deduct up to $1 million, $1,050,000 in equipment or qualified property in the year that was placed in service. For a business, that can be a massive deduction. Qualified property means it's not real estate. It's usually equipment and things like that. It can be an SUV. My clients know this, but if you have an SUV, you may qualify for a $25,000 deduction up front. I get asked every year, does that still in play? If you have an SUV, definition over 6,000 pounds gross vehicle weight, you can still take that $25,000 deduction. But you also are allowed bonus depreciation of 100%. Sounds kind of counterintuitive, but in essence, what we're saying is for most SUVs, to the extent that there's business use, you may be able to deduct the entire amount of the purchase, even if it was made late in the year. California does not have the same provisions for the SUVs or the Section 179, but this is a very beneficial provision. It's been in existence for some time. What's changing is they keep increasing the amount you can deduct. Bonus depreciation. So not only is there Section 179 if you're in business, but you're also able to deduct up to 100% of qualified other types of property placed in service between 2017 and January 1st, 2023. And they've expanded the definition of what qualified investment property is to include some improvement type property, very generous, very important tax deduction for people in real estate and not in real estate. California has not the same provisions, so there will be large adjustments. But know that if you're a business and you're capital intensive, that there are huge deductions out there for your first year deployment of assets. There's a limitation of business interest that was put into place in 2017, but that has been suspended because of COVID. And now people are allowed, which the 163A, which limits the net interest business expense deduction for all taxpayers other than expected businesses to 30% of their adjusted gross income. That number has been suspended. And now you can go back and recover some of the loss deduction from the prior year based on this provision, based on these new laws, again, triggered by COVID. I'm going to pass on that. And then just quickly, in the last seconds allowed, and I'm still doing okay, I want to go through some retirement provisions. Some are basic. Your IRA deduction amount, $6,000 again for this year. $6,000, you must have earned income of that amount to take the deduction. If you're an active participant in a plan, your income may trigger it not being allowed, in which case you might want to explore some other options, like maybe a backdoor IRA or something like that. But as I said, the maximum contribution is $6,000. Important to note, if one spouse is working and the other isn't, the non-working spouse can draw from the earning spouse to get that deduction up to $12,000. You don't both have to meet the earnings requirement. As I said, if you're in an employer-sponsored plan, the deduction gets phased out. The numbers are low on this. It's between $104,000 and $124,000 is where you don't get the deduction if you're in an employer-sponsored plan. If your spouse, if you are not an active participant, but your spouse is, those thresholds are higher, $196,000. Remember, the old rule is that you can make a contribution after you age 70 and a half to an IRA. The Secure Act removed that age restriction. California does not conform to that, however, so you might have a different IRA deduction between Fed and state. Again, I mentioned this earlier, but a spousal IRA contribution can be based on the other spouse's earned income. Important note, a lot of people don't know that. New because of COVID, taxpayers may make a penalty-free related coronavirus withdrawal of retirement funds up to $100,000 in the aggregate between January 1st and December 30th of last year. In addition, the taxpayer may spread the withdrawn amount in taxable income over a 3-year period beginning in 2020. So if you are in a scenario that I will outline related to coronavirus, you will be able to take a $100,000 distribution without having a penalty, and you can pay tax on that $100,000 over 3 years, the regular income tax rather than upfront. That's very important. It's qualified for all types of plans, essentially the defined benefit plans. For some reason, they have a provision that doesn't allow you to do it if it's a defined benefit plan. What are related coronavirus distributions that qualify? As I said, it must be between January 1st and December 31st. It's to a person who's been diagnosed with COVID. It is to a person experiencing adverse financial consequences as a result of being quarantined, furloughed, having work hours reduced, being unable to work due to a lack of childcare, the closing of reduced hours of a business, or other factors determined by the Secretary of Treasury. In essence, a very broad brush for who qualifies for coronavirus distribution that would allow you a penalty-free distribution and allow you to pay tax over 3 years. Penalty-free withdrawals from the qualified retirement accounts up to $100,000 are not subject to withholding. Qualifying distributions on or after the first day of the incident period and before June 25th, 2021 are the qualifying distributions. And these are distributions that are not just related to COVID. These are related to disaster relief, non-COVID related, like the fires, have a similar type of protocol to get a tax-free loan, a penalty-free loan, and be able to pay the tax over a period of time. You are allowed to take loans from plans up to $100,000 rather than $50,000. And the period of repayment has been extended, again, as a result of COVID. The required minimum distribution, the RMD rules, I'm getting to the end here. Those have changed. It's not 70 and a half anymore. A lot of you have memorized that. It's now 72 is the key period when you must begin taking required minimum distributions. Taxpayers who make traditional IRA contributions after 70 and a half cannot offset the RMD for the same year by those. And then there's an example. So the RMDs also were waived for 2020. We're a little late in the game for this, but the 2020 required minimum distribution suspension does not apply again to defined benefit plans, but applies to all other plans. So the RMD was not required for 2020. And finally, the Roth provisions, the thresholds for Roths are different than the others in terms of who can make a Roth. They're low. It's 196,000. Well, it's not that low. It's pretty similar for a Roth IRA. They do not have an age limit on who can make a Roth IRA. But people who have a problem with that income level and want to make a Roth contribution, they consider the infamous, or not infamous anymore because they're pretty much ordained by the IRS as well, the backdoor IRA. If your income is too high to make a Roth contribution, the idea of a backdoor Roth conversion is that you make a non-deductible IRA contribution, which does not have the income constraints. And then you convert it to a Roth. It seems silly that you'd be allowed to do this, but right now you can. So you convert your traditional IRA to a Roth, and therefore you have the Roth characteristics of the IRA, which means that when you pull it out, it will not be taxable. That's the backdoor IRA. But a huge final warning on a backdoor IRA, which is if you have other IRA contributions over the years and you take the distribution out at the end from what you thought was this completely tax-free distribution from the backdoor Roth, you have to accumulate all of your prior contributions to determine what the numerator and denominator are, to determine what portion of your distribution is taxable. It's not going to be all tax-free as a Roth if you have other non-Roth type elements to your IRA portfolio package. So, wow, that's a lot of information. That was a speed round. The curtain has been drawn. Bruce Springsteen never did show up for this presentation, so I'm sorry about that promise that wasn't kept. But Monique, if there are questions, I do have time as it turned out. We're at 11:15, which is just about what I thought it would be. So if you're there and have some questions, you can shoot them or you can just send them to me later.
Yeah, thanks, Tom. There were a few, but can we still apply for the PPP?
You can still apply. So you can still apply for the original PPP if you haven't used it or had the first one forgiven. If you apply for it, you'll have the more liberalized terms of the new PPP apply, which means you could do that new PP and have the employee retention credit as well. But yes, you can. The funds are, if they're asking, are funds still available? The answer is, to my understanding, is yes. It's up to 960,000 billion of total funds. I think there's still funds out there to apply for the PPP.
Awesome. Yeah, that was it. I thank you. Oh, Lily asked, can I apply retroactively for Q4 2020 ERC?
That's a good one. So the answer is yes. So the ERC, if you can go back and apply for it, this allows me to add a kind of a helpful, not only can you, but you need to know mechanics. You can do an amended 941 for the retention credit if you now qualify because the rules change. But there is also, I haven't seen the form, but my understanding is there is a catch-up provision in new 941. So rather than having to amend your old 941s where that questioner was asking, you could go on the new 941s and just report the amount that would have been allowed on the old 941 on your new 941 and not have to go through an amended protocol. So that's really cool. So not only can you do it, but you can do it in a catch-up way faster. So that's a good question. I'm glad that somebody pointed that out.
One more. If we went through our bank and are having difficulty connecting through our original bank, Wells Fargo, for example, can we go through another bank and amend our first PPP?
Wow. So I was asked that. I was in the process of asking. I don't know if that's true. I don't know if you have to amend or start afresh with that scenario because those loans are submitted. They're kind of a formal deal. So I would keep at it with the old lender to make sure that these new amendments, if you haven't applied for forgiveness yet, and that's the big if, that they are able to revise it. But otherwise, that is interesting. You know, I think the reason I'm troubled answering is I don't know that there's interim rules that have been passed that actually address the non-cooperative lender scenario. Let me tell you, all along the way with the PPP loans, they have the Small Business Administration's been issuing these interim guidelines because things weren't addressed. So if I find out more on that, I'll check it out. But I think that you should stay with your original first until all options are expelled there, and then go to a new lender.
All right. Last one. What limits are there for ERTC versus PPP forgiveness?
Oh, well, see, the definition of the qualified loan and the definition of the qualified forgiveness are the same under both provisions. There are a couple of things that were actually liberalized in the new one, which is the covered period now can be more of your choosing rather than 8 weeks or 24 weeks. But the new PPE loan, as I said, changed a little bit of a more specific definition of who qualifies in terms of whether or not your business is specifically having losses. But otherwise, those are the changes. There's some changes in the rules, but generally who qualifies for the loan has not changed.
Awesome. All right. Well, if anyone else has any questions, Tom will do his best to send them out via email after. Thanks, Tom.
Beth, thank you.
Bob, all yours.
Yeah, thank you, Monique and Tom and your entire team at PP&Co. We really appreciate your partnership, and congratulations again on your 70th year in business.
I have not been here all 70 years, just so you know.
We'll give you some credit for that, though, Tom. But thanks again for everything. Just so for folks to know, we continuously update our website and social media channels with the latest COVID-19 updates, including resources and vaccines. So be sure to follow us and subscribe to our newsletters. One thing we want you to be aware of is we have an event scheduled for Wednesday, the 24th. It's our member breakfast. It's one last conversation with Kim Wallish, who's been an incredible leader for the city of San Jose. And we hope that we hear some unvarnished comments from Kim as she is on her way to a gap year, as she says. So we want to wish you all a good day. Again, thanks for being here, and hope you benefited greatly from today, which we sure feel we did. So thanks again, everyone.
Thank you.
Thanks, Tom. See you for the next one.
Oh, okay. You tricky.